Imagine buying the top of a bull run, watching your portfolio bleed 20 to 30%, and having no idea why the market suddenly turned against you. Most traders lose money not because they are bad at charts, but because they don't understand the big cycle, when stocks, bonds, and commodities take turns leading the market. What if I told you there is a simple 6-stage framework created by legendary analyst Pring that shows you exactly which asset class is about to shine and which one to avoid? Just like the 6 seasons of the year. Stick with me for the next 16 minutes, and I'll show you how to stop fighting the market and start riding its natural rhythm with patience and confidence, the Titiksha way. So, who is Pring? He is one of the most respected technical analysts in the world, author of over 15 books, and the man who taught thousands of professional traders how to read the bigger picture of the market. For decades, big institutions have used his methods. But today, I'm going to break it down in the simplest way possible. Here's why this model is a complete game changer for people like us. Most of us focus only on charts, candlesticks, and indicators. But we keep getting surprised when the trend suddenly changes. Pring's 6-stage business cycle model shows you the natural rhythm of the market, just like the 6 seasons in a year. Think about it. There is a season when bonds do well, like winter, calm and safe, a season when stocks shine, like spring, new growth, a season when commodities like crude oil and metals take the lead, like summer, hot and energetic. And just like seasons, these stages always follow a certain order. When you know which season the market is in, you stop guessing and start positioning yourself ahead of the crowd. In the next few minutes, I'm going to walk you through all 6 stages, one by one, with simple examples from our Indian market. By the end of this video, you'll have a powerful new lens to look at Nifty, gold, and crude. So, are you ready? Let's begin with Stage 1. Stage 1 is the first season of the market cycle. We can call it the winter of the market. This stage usually begins when the economy is at its weakest, during or just after a recession. Business activity is slow, people are losing jobs and confidence is low. Here's what happens in Stage 1. Bonds start performing well. Why? Because the RBI, or central banks, start cutting interest rates to support the economy. When rates fall, bond prices rise. So government bonds and debt funds become attractive and safe. Stocks are still falling or weak. The news is mostly bad and companies are struggling. Commodities like crude oil and metals are also weak because demand is very low. Simple analogy, just like in winter, everyone wants warmth and safety. In the market, investors run towards the safety of bonds. What should you do in Stage 1? Reduce aggressive stock buying. Move some money into safe bonds or liquid funds. Protect your capital. This is the time for patience, the Titiksha way. Don't try to catch a falling knife in the stock market. Remember the period after the 2020 COVID crash, or during heavy FII selling phases. When Nifty was weak and crude oil prices were very low, government bond yields started falling. That was classic Stage 1 behavior. The good news? Stage 1 doesn't last forever. When bonds have already started recovering, the market slowly moves into Stage 2, where stocks begin to wake up. Let's move to Stage 2. Welcome to Stage 2, we can call this the early spring of the market. The economy is still weak, but something important has started happening. The central bank has already cut interest rates, and smart money is sensing that the worst is behind us. Here's what happens in Stage 2. Bonds continue to do well. Stocks start bottoming and begin to rise. Why? Because investors start looking ahead and anticipate economic recovery. Commodities are still weak because actual demand hasn't picked up yet. To call out a simple analogy, in early spring, the snow is melting and new plants start sprouting even when the weather is still cold. Stocks are like those early green shoots, they rise before the full recovery is visible. What should you do in Stage 2? This is the time to gradually increase exposure to quality stocks, especially defensive and interest rate sensitive sectors like banking, FMCG, auto and realty. Keep some money in bonds for safety. Start buying on dips with a calm mind. To call out an example, after the 2020 bottom, when RBI had cut rates aggressively, Nifty started recovering sharply while crude oil was still low. Many stocks gave excellent returns in this phase, even when the economy was not yet fully recovered. This stage is where patient traders who followed stage 1 get rewarded. As stocks gain strength and the economy improves further, the market moves into stage 3, where everything starts doing well together. Let's go to stage 3. Now we enter stage 3. This is the full spring or the most joyful season of the market cycle. The economy is clearly recovering. Business is improving, jobs are coming back, and confidence is rising. In this stage, bonds are still performing well, though they are getting closer to their peak. Stocks are in a strong uptrend. Commodities like crude oil, copper, metals also start rising as industrial demand picks up. All three asset classes are now bullish together. This is the sweet spot of the business cycle. Simple analogy: think of a beautiful spring day where flowers are blooming everywhere. Bonds, stocks, and commodities all do well at the same time. What should you do in stage 3? This is the time to be invested in the market with good exposure to stocks, especially cyclical sectors like auto, capital goods, metals, and banking. You can be more aggressive, but still maintain discipline. This is where compounding works beautifully if you stay patient. For example, the period between late 2020 to mid-2021 was a classic stage 3. Nifty rallied strongly, bond yields were stable or falling, and commodities like crude oil and metals also started a strong recovery. Many sectors gave excellent returns during this golden phase. But remember, nothing lasts forever. As the economy heats up too much, inflation starts rising, and we eventually move into stage 4, where bonds start struggling. Let's understand stage 4. Stage 4 is the late summer of the market. The economy is running hot, but warning signs start appearing. The recovery has been strong for a while. Demand is high, factories are working at full capacity, but inflation is now rising. Here's what happens in stage 4. Bonds start underperforming. Bond prices fall as interest rates rise. RBI may start worrying about inflation. Stocks continue to rise, but leadership changes. Defensive stocks weaken while cyclical and inflation-sensitive stocks do better. Commodities, crude oil, metals, etc. become strong performers. A simple analogy could be the late summer. It's still warm and energetic, but you can feel the heat is becoming uncomfortable. Commodities and cyclical stocks love this heat. What should you do in stage 4? Reduce exposure to long-duration bonds. Stay invested in stocks but rotate towards sectors that benefit from inflation: energy, metals, mining, commodities-related companies, and select industrials. Be cautious with rate-sensitive stocks like NBFCs and realty. This is the time for selective aggression. For example, we saw strong stage 4 characteristics in 2021 to 2022 when crude oil prices surged. Metal stocks like Tata Steel, Hindalco, and energy stocks rallied sharply, while bond yields rose and long bonds suffered. Nifty kept making highs but with clear sectoral rotation. Many traders get greedy here and ignore the warning signs. But if you stay disciplined, you can still do well. As the cycle matures further, we enter stage 5, where stocks start tiring. Let's move to stage 5. Stage 5 is the late summer turning into autumn. The party is slowly ending. The economy is still growing, but cracks are now visible. Inflation is high, interest rates have risen significantly, and the market starts worrying about the next slowdown. Here's what happens in stage 5. Bonds continue to struggle, prices keep falling. Stocks start topping out and begin to decline. The broad market weakens. Commodities remain strong for some more time because of previously built-up demand and inflation. A simple analogy could be the end of summer when the leaves start changing color. Stocks lose momentum first, but commodities can still stay firm for a while. What should you do in stage 5? Be defensive with your stock portfolio. Book profits in stocks that have run up a lot. Reduce overall equity exposure. Commodities and related stocks, energy, metals, can still offer opportunities. This is the time to tighten your stop losses and prepare for tougher times ahead. Patience is key, don't chase the last rally. For example, in late 2021 to early 2022, while Nifty started showing weakness and corrected, commodities like crude oil and some metal stocks continued performing well for some time as inflation remained high. Many traders who didn't rotate got trapped in the subsequent fall. The market is now preparing for the final stage. Let's go to stage 6, the most challenging one. Finally, we reach stage 6, the winter of the market has fully arrived. This is the most difficult season. The economy slips into recession or a sharp slowdown. Demand collapses and fear spreads in the market. In stage 6, bonds are falling, though they will bottom first. Stocks are in a downtrend. Commodities finally peak and start declining. All three major asset classes are now weak together. This is the liquidation phase. Simple analogy could be deep winter when cold, dark, and everything feels frozen. Very few things grow. What should you do in stage 6? Stay highly defensive. Move to cash or very short-term instruments. Avoid taking big risks. This is the time to preserve capital and wait patiently. The best opportunities come after this stage ends. Remember, bonds always lead the next recovery. For example, the 2008 global financial crisis and the initial 2020 COVID crash were strong stage 6 environments. Almost everything fell together until the RBI stepped in with massive rate cuts, marking the start of stage 1 again. And here's the beautiful part. After stage 6, the cycle restarts with stage 1. The market always recovers. Those who understand this cycle and follow it with discipline can survive and thrive for decades. So, how can you actually apply Martin Pring's 6-stage model in your daily trading? Here are practical tips specially for traders or investors. 1. Track the big 3 regularly. Bonds. Keep an eye on the 10-year GSEC yield or India bond ETF charts. Stocks. Check if Nifty 50 and Bank Nifty confirm each other. Commodities. Brent crude oil and the MCX metal index should confirm each other. 2. Use tools to spot the stages quickly. Head over to investing.com or TradingView. Compare charts, plot Nifty versus crude oil or Nifty versus the 10-year GSEC. Watch the stock-to-commodity ratio. When it rises, stocks are leading, that's stage 2 and 3 territory. When it falls, commodities are taking over, stages 4 and 5. For deeper insight, add the 50-day SMA and the KST indicator. 3. Follow these actionable rules. In stage 1 and 2, focus on defense and start buying quality stocks early. Stage 3, ride the broad market rally. Stage 4 and 5, rotate into energy, metals, and commodities-related stocks. Stage 6, stay mostly in cash or very safe assets. Now, let's talk about common mistakes to avoid. Ignoring the cycle and buying stocks aggressively in stage 6. Staying in long bonds when yields are rising in stage 4 and beyond. Getting too greedy in stage 3 and forgetting to book profits. Trying to predict the exact stage without waiting for confirmation. Start small. Every quarter, spend time reviewing these 3 asset classes. Over time, this single habit will give you a massive edge. Remember, this is not about predicting the future perfectly. It's about increasing your probability and trading with calm confidence, the Titiksha way. Ultimately, Martin Pring's model is not just about charts, it's about mindset. When you understand the 6 stages, you stop chasing every rally out of FOMO. You stop panicking during corrections. Instead, you develop Titiksha, the power of patient endurance. You learn to wait calmly in stage 1 and stage 6. You participate enthusiastically in stage 2 and 3. And you rotate wisely in stage 4 and 5. This cycle awareness gives you something most retail traders never have: emotional stability and long-term conviction. That is real wealth creation. Not just money in the account, but peace in the mind. This is the true Titiksha finance way. To sum it up, the market moves in 6 clear stages, just like seasons. Martin Pring's model shows you when bonds, stocks, and commodities take turns leading. Master this framework, and you will trade with more clarity, patience, and confidence. Key takeaway: stop fighting the market. Learn to flow with its natural cycle. That is the real edge. If you found this video helpful, please hit the like button, subscribe to Titiksha Finance and press the bell icon. Comment below, which stage do you think the Indian market is in right now? Share this video with your trader friends, someone might thank you later. In the next videos, we'll dive deeper into another important concept. Until then, trade patiently, stay disciplined, and let Titiksha guide you. I'll see you in the next one. Take care.